Three ABLE account rules matter in 2026. And for a 68-year-old widow afraid to deposit a $12,000 inheritance, the first could decide whether she protects that money or loses the benefits paying her bills. Subscribe for clear updates on senior money, disability benefits, Social Security, Medicare, and important rule changes. Picture a 68-year-old widow. I'll call her Margaret. The name is made up, but the problem is very real. A sealed envelope sits beside her bank statement and her SSI deposit notice. Inside is an inheritance check for $12,000. She has held it over a deposit slip more than once, then pulled her hand back. Putting that check into her ordinary bank account could push her resources too high and threaten her SSI eligibility. So the envelope stays closed, and the money stays on the kitchen table. Margaret assumes ABLE accounts are meant for young people. She sees her age on the bank form and decides the answer must be no. Nobody calls to correct her. The state program cannot act on an application she never files, and nobody responsible for administering or collecting money is going to call and tell her she may have another option. That is the gap. Being entitled to use a program and actually using it are two different things. If you are over 60, do not let your current age answer this question for you. The date your disability began is the date that matters. 3 rules control 3 separate doors. One asks whether you can qualify, another controls how money may enter the account. The last one, which we are saving because it settles the biggest fear, explains what can happen to SSI and Medicaid after the money goes in. And please hear this before you quietly walk away. Having very little money does not make the account pointless, while receiving an inheritance or holding some savings does not automatically make you ineligible. Each rule serves a different circumstance. Let the actual program test decide. My name is Walter Hayes. For more than 15 years, I have read the fine print in government programs for ordinary families sitting at tables just like yours. I do not sell anything, and I do not work for the government. I read the rules so you do not have to. Then, I turn them into the question you can ask when a real person answers the phone. I also want to clear away the biggest myth before it costs you time or money. Not every disabled senior qualifies for an ABLE account, and not all 3 protections suddenly appeared in 2026. The 1st of January 2026 changed the disability onset threshold. The annual contribution ceiling increased as well. The safeguards involving SSI and Medicaid already existed, but they now matter to a much larger group of people who may pass the expanded age test. That distinction matters. It keeps a hopeful headline from becoming a dangerous promise. Do not count yourself out at your own kitchen table because you think you have too little money or too much. Here is Rule 1. The ABLE Age Adjustment Act replaced the old requirement that a qualifying disability begin before age 26. The new test asks whether that disability began before the person's 46th birthday. Notice what the law measures. It measures when the condition began, not how old you are when you open the account. A person who is 68 today may still meet the timing rule if the disabling condition began at 45. A person who is younger could fail that same test if the condition began later. The birthday printed on your current identification card does not settle it. Now ask yourself one concrete question. How old were you when the condition began, and where is the record that proves it? The answer may be sitting in an old medical folder, a Social Security decision, or a benefits notice saved in a desk drawer. Eligibility may be established through SSI, SSDI, childhood disability benefits, or disabled widow or widower benefits. Those benefit routes can provide the program with evidence of a qualifying disability, but they do not mean every application is approved automatically. The state ABLE program still has procedures you must follow. Someone who does not qualify through one of those benefit routes may be able to use the ABLE program's disability certification process. That route generally requires a physician-signed diagnosis and certification involving a severe impairment expected to last at least 12 months or result in death. Plain English. The program needs proof of a serious, long-lasting condition, plus proof that it started before the new age line. A recent doctor's visit can describe what is happening now. It may not, by itself, prove when the condition first began. That is why the old record matters. Go back to Margaret's sealed envelope. Suppose she opens a worn medical file and finds a diagnosis showing her disabling condition began when she was 43. That single date changes the question. Being 68 does not automatically shut the door, because 43 falls on the qualifying side of the before 46 line. She still needs the state program to review her documents, but the age loop that froze her at the bank counter now has an answer. Her next move is not to deposit the inheritance in hope. It is to call a state-able program with the medical record in front of her and say, "My disability began before age 46. What records and physician-signed diagnosis do you require for certification?" Then she writes down the representative's name, the required documents, and where they must be sent. One careful phone call turns a guess into a checklist. But qualification is only the first door. Margaret may pass the before 46 test and still make a costly mistake if she moves the check before learning how the funding rule works. The unopened $12,000 inheritance now raises one exact question. Under the new 2026 ceiling, does that $12,000 count by itself? Or must it be combined with every contribution anyone has already made this calendar year? It must be combined with every contribution anyone has already made during the same calendar year. Under Internal Revenue Service, Revenue Procedure 2025-32, the standard annual able contribution limit for 2026 is $20,000. That is the combined annual total from the beneficiary, relatives, and other contributors. One shared ceiling. Stop here and check the wording. $20,000 total, not $20,000 per person. That detail changes what happens to the check sitting inside Margaret's unopened inheritance envelope. Imagine her sister deposited $3,000 into the account in February. A cousin added $1,000 in May. Margaret would begin with $4,000 already counted against the annual ceiling, leaving $16,000 of standard contribution room. Her $12,000 check could still fit, but the ledger has to show every deposit, including money Margaret contributed herself. Change that ledger, and the answer changes. Suppose relatives and other contributors have already placed $9,000 into the account during 2026. Only $11,000 of room remains beneath the standard ceiling. Depositing the entire $12,000 inheritance would push the combined total $1,000 too far. The check amount did not change. The earlier deposits did. This is the funding trap. A birthday gift arrives. A relative sends money directly to the program. Then Margaret deposits the check without checking the account history. Each transfer may look harmless by itself, but the program counts them together on one calendar year ledger. The safe order is simple. Check the total, calculate the remaining room, and only then move the money. An excess contribution can create a problem that one phone call could have prevented. There is another point people often assume incorrectly when they see a special account. Ordinary able contributions receive no federal income tax deduction. Putting $12,000 into the account does not normally create an upfront federal deduction for Margaret or for a relative who contributes. The value comes later through the way properly held account money can interact with means-tested benefits and through the potential tax treatment of qualified disability expenses. Some employed beneficiaries have another option called able to work. It may allow certain working account owners to contribute beyond the standard annual limit, but that extra room is governed by separate limits, and participation in certain retirement plans matters. A pay stub alone does not give someone permission to add an amount they chose themselves. The beneficiary must verify the program rules and personal eligibility before treating able to work as additional space. That means a working viewer should never copy a number from another person's account or an old information page. Call the state program. Explain that you are employed. Ask whether able to work applies to you, what limit the program will use, and whether retirement plan participation affects your eligibility. Get the answer before the next payroll deposit reaches the account. That keeps the standard ceiling and any permitted work contribution from becoming one confused pile of money. Now, bring the calculator back to Margaret's kitchen table. Do not fund first and calculate later. Make the program tell you how much room remains. Her $12,000 inheritance fits beneath the standard $20,000 ceiling, only if all earlier contributions during 2026 leave at least $12,000 available. In plain terms, the combined amount already contributed must be no more than $8,000 before she deposits the entire check. If the ledger shows $7,000 already contributed, her check would bring the calendar year total to $19,000. It fits. If the ledger shows $10,000, only $10,000 of standard room remains. She would need to stop, keep part of the inheritance outside the transfer, and ask the program what steps are available. The envelope stays sealed until the arithmetic is settled. But the annual ceiling is only one limit. Each state plan also has a lifetime account limit, meaning a cap on how large the account may grow over time. Passing the annual test does not prove that a deposit passes the state plan's balance rules. Margaret may compare different state ABLE programs, including their fees and lifetime limits, before choosing where to open or fund an account. One webpage may answer the yearly question, while another page holds the long-term cap. Before moving the check, Margaret calls the program and asks, "How much has already been contributed this calendar year, and what is your state's lifetime account limit?" Those two questions force the phone conversation toward the numbers that matter. She can write the answers on a notepad beside the check, record the program name and date, and compare the figure with the account ledger. That is disciplined, practical protection before a single dollar leaves the kitchen table. Getting the contribution right still does not settle what happens when Margaret later takes money out. A deposit that stays within the ceiling does not make every withdrawal tax-free. The expense matters. So does the paper trail, showing where the money went. If you think getting the money into the account ends the job, stay with me. The receipt can matter as much as the deposit. Housing, transportation, healthcare, assistive technology, education, employment support, and financial management may fall within qualified disability expenses when the rules are met. But Margaret cannot simply label any purchase a disability expense after the fact. She needs to connect the withdrawal to a qualified purpose and keep every qualified expense receipt. A dated invoice, a rent record, or a transportation receipt may become the proof behind the account's tax treatment. And that brings us to the question hiding behind the unopened envelope. Margaret may qualify under the before 46 line. She may confirm enough annual room and deposit the full $12,000. But will Social Security actually ignore that balance when it reviews her supplemental security income resources? And if the account grows over many years, do her cash benefit and Medicaid follow the same rule? They do not. Even if Margaret's $12,000 fits under the combined $20,000 ceiling, the decisive number is still ahead. The supplemental security income exclusion covers an ABLE balance only up to and including $100,000, and the treatment of supplemental security income cash and Medicaid beyond that line is not the same. And that difference matters the moment an account statement crosses the highlighted line. Properly held ABLE funds are generally disregarded by means-tested federal programs. For SSI specifically, an ABLE balance up to and including $100,000 is excluded from the resource calculation. That is the protection Margaret needs for the check sitting inside her unopened inheritance envelope. Above that line, the paths split. If the ABLE balance over the exclusion causes Margaret's total countable resources to become excessive, her SSI cash payments can be suspended. Medicaid may continue if she otherwise remains SSI eligible. Neither protection is unlimited, and the details have to be checked against her full situation. Do not merge those two outcomes. The rule can pause one payment without automatically ending the other. Now bring the number back down to Margaret's kitchen table. Her inheritance is $12,000. If her ABLE application is approved, the program confirms enough contribution room for the calendar year, and the deposit follows its rules. That amount is far below the SSI exclusion line. The inheritance does not automatically become an ordinary countable bank balance simply because she finally deposits the check into an approved ABLE account. But protecting the balance is only half the job. Margaret also needs to know what happens when she spends it. Qualified disability expenses can include housing, transportation, healthcare, assistive technology, education, employment support, and financial management. Think rent paid from the account, a wheelchair-accessible vehicle repair, medicine at the pharmacy counter, or equipment that helps her live safely at home. Withdrawals used for qualified disability expenses can receive tax-free treatment. The word qualified is doing real work there. An ABLE account does not turn unrelated personal shopping into disability spending, and it does not erase the need to follow the program's rules. Margaret must connect each withdrawal to an eligible cost. That resolves the proof question. Every qualified expense receipt goes into one folder. Margaret writes down the date, the amount withdrawn, and the eligible bill it paid. If a debit from the account covered transportation, she keeps the transportation record. If it paid for assistive technology, she keeps the invoice. A clean paper trail is much easier to build one receipt at a time than 2 years later at a crowded kitchen table. There is another limit families need to see before treating the account as a place to pass money to heirs. State Medicaid recovery may apply after death. Margaret should read the recovery disclosure for the state program she chooses and consider her individual circumstances. An ABLE account can protect eligible funds during life, but it should not be described as a guaranteed inheritance shelter. This is the rule I asked you to stay for. Margaret's current age does not erase a disability that began at 43. Because her onset was before the 46 line, she may qualify at 68. Approval still depends on the records and certification accepted by the ABLE program. Her birthday today does not rewrite the date her condition began. If the program approves those documents and confirms sufficient annual contribution room, Margaret may deposit the $12,000 inheritance check into the approved account. She may potentially contribute up to the $20,000 standard limit during 2026, counting all contributions from every source together. Properly handled, that gives her a way to hold her own money without automatically sacrificing SSI or Medicaid. That is the full payoff behind the 3 rules. The wider onset test may open the door. The $20,000 ceiling controls how much standard contribution room exists during 2026. The benefit safeguards determine how qualifying funds are treated after they enter the account. Miss any one of those pieces, and money can still be left on the table. Be precise about the value. This is not a new $12,000 government payment, and it is not a promise that every disabled senior qualifies. It is the possible ability to protect Margaret's own $12,000 under ABLE rules instead of leaving the inheritance envelope unopened because she is afraid of crossing the ordinary SSI resource limit. Take out one sheet of paper and write these 4 steps down before you move any money. First, locate records showing that the disability began before age 46. Look for dated medical records, benefit records, or the physician-signed diagnosis the selected program requires. Do not rely on memory when a document can establish the date. Second, compare state ABLE programs and their certification requirements. Ask what evidence they accept, what fees they charge, and what disclosures govern the account. You may have choices beyond the program connected to your home state, so compare the actual terms. Third, confirm the calendar year contributions already made, the annual limit, and the program's lifetime balance rules before funding. Use the literal question, how much has already been contributed this calendar year, and what is your state's lifetime account limit? Wait for the answer before Margaret moves the inheritance. Fourth, keep every receipt for qualified disability expenses. Match each receipt to the withdrawal that paid it. A folder labeled Housing, Transportation, Healthcare, and Assistive Technology is simple. Simple works. One more warning. An unsolicited caller may offer to activate an ABLE account or demand bank details to secure the new rules. That caller is a scammer. Do not give a social security number, account password, or routing number. Contact the state ABLE program, SSA, or a SHIP counselor yourself. Stop. Hang up. You go to them. Use a telephone number from an official government or state program website, not a number sent in a surprise text. A real rule change does not make a cold caller entitled to your banking information. You choose the office, you place the call. Margaret can now open the envelope, place the check beside her 4-item list, and ask the right questions before depositing $1. The outcome is conditional, but it is no longer mysterious. Certification, combined contributions, account balances, eligible spending, receipts, and state rules all have a clear place in the decision. She did not qualify because she turned 68. She may qualify because her disability began before 46. She did not know the option existed, and now you do. General education only, not personal legal, tax, or financial advice. State rules and individual circumstances vary. Income, benefits, and program terms can change the result. So confirm your situation with the state program, SSA, SHIP, or an appropriate qualified professional. If this could help someone you love, send it to one person over 65 who may need to verify the same rule. Nobody official is likely to see that unopened envelope on their kitchen table and call to explain the option. You might be the person who helps them ask.